Hello, this is Josh Belk with the Belk on Business podcast. Today we're going to hop in, and it's going to be a little bit of a briefer podcast. I'm going to try to give a lot of information in a very short period of time. Once again, I think it's the second podcast in a row I'm going to do this, but we, of course, and you're probably getting a lot of information on this as well, or at least notification, or people trying to reach out to you to be able to file these BOI reports. But this is kind of what we're going to hop in today is this Corporate Transparency Act. And I'm really going to kind of gear this more toward the clientele of my business. Of course, this is going to go out to them, and we'll be following up for those of you who are clients. We'll be following up in regard to collecting this information here in the next week or so, and so we can go ahead and get these reports filed. But this BOI report, this Corporate Transparency Act, has been something that there's been, I guess, quite a bit of information put out there in regard to this new requirement, at least this filing requirement that every active business, or nearly every active business inside of the U.S. is going to need to file at some point this year. So let me kind of hop into this. I'm going to give you some high-level information. I'm not at all going to dig into a whole lot of the specifics. Because it can be very complicated. But I think what we'll be able to successfully do here is be able to provide at least a high enough level of view for you to know exactly whether or not you are required to file a report or the timeline in which it needs to be filed. So let's hop right into this. In 2021, as part of the National Defense Corporation Act, the Corporate Transparency Act was enacted, and it went into effect January 1st of this year, of 2024. Its intent was to provide national interest or protect the national interest against money laundering and the financing of terrorism. So that's the mentality. I kind of joked about this last week, although it's not at all funny, how we simply open the borders. Anybody in the world can come walking across, but we're going to essentially pick on small businesses primarily and require for them to disclose all this information when we simply allow for people just to walk right across the border. It's just absolutely mind-blowing to me. But anyway, as business owners, this is just something we're going to have to deal with. So the objective essentially is to try to help prevent the misuse of certain types of entities, and these entities are LLCs, corporations, and partnerships. Trusts generally are excluded from this, with one exception, and I'll talk about that here in just a moment. So it really is to try to help prevent the misuse of certain types of entities by bad actors. So those who would use entities within the United States in order to use the money for ways that obviously would be in opposition to the national interest or the national defense of the United States. And so, first of all, to get that disclosure of information, and then secondly, to try to create this database of information in a manner that would be useful, at least when I say useful to the federal government. Now, I could, of course, get into the politics of this as kind of a little bit more libertarian mindset. I prefer the government to stay out of my business altogether and even stay out of many of the social issues. However, this is the environment in which we live in. They're stepping in, kind of stepping on our toes, and we allow it, unfortunately, because we vote these yahoos into office, but essentially this is what we're going to have to deal with as small business owners until such time as we as the population decide to put people in office that aren't going to be prying into our business as much. So this BOI report, which is the beneficial ownership information report, is to be filed with the FINCEN, which is part of the Department of the US Department of Treasury. So it's the Financial Crimes Enforcement Network, and this will need to be filed online. A reporting company that is any company, namely LLCs, partnerships, and corporations, as mentioned a moment ago, that registers with the state's Secretary of State. So if you have a business that you register with a Secretary of State or the equivalent, sometimes Department of State, they have different names, but think of the Secretary of State's office in your particular state or any state in which you have an entity. If you have to register that particular entity and it is an active business, and I'll talk about that here in just a moment, then it will need to file this particular report. Or if it's a foreign entity registered to do business in the United States. I'm going to not talk, I may mention a time or two, but not talk at all or go into any depth at all on the foreign side. This isn't our clientele base, but just to be aware out there, if you have a foreign owner or there's a foreign entity involved, whatever the case may be, you're going to have more specific rules. So you'll want to either, if you're a client of ours, reach out to us individually, or if you're not a client of ours, reaching out to your accountant to make sure that that information is filed. So these entities are registered with the State Secretary of State's office. It's an active business, and it's not one of the exemptions. You're going to have to file this report. So not all entities are required to file this report. There are 23 exemptions. Most of these exemptions are entities that already have some sort of anti-money laundering regulation that they fall under. So you think about banks, insurance companies, financial institutions, government entities, etc. So that's a great number of these 23, but there are also other types of businesses. Nonprofits are exempt from this generally. Subsidiaries of nonprofits, larger companies, I'll give it a definition of that here in just a moment, public utilities, and inactive companies. Okay, so an inactive company is an entity that has not had any movement of over $1,000 in the last year or had any sort of a change of ownership. So if it's had any sort of activity at all, either at the entity level, switching out owners, whatever the case may be, or it had any money movement in excess of $1,000, you're going to need to file this report. So essentially, if your entity is registered with the Secretary of State, in all probability, you're going to have this filing. If your entity is not conducting business any longer, it may behoove you to go in and file articles of dissolution with the state and go ahead and not have this on the books. We have actually had clients who have decided to start kind of rolling up their businesses to try to simplify things, just because there is a real big push against any sort of being able to operate with any sort of anonymity with all these disclosure requirements and the expense of the compliance of it as well. So a large operating company is one of the exemptions. A large operating company is one that has over $5 million in gross receipts in the previous year and has over 20 full-time employees and also has a physical office in the United States. So if you're listening to this and you have over $5 million in revenue in the past year, we look at the last tax return filing, which in this case here, if you look back at your 2023s, if it's an existing business, you have over $5 million in gross receipts, you have over 20 full-time employees, you would qualify. So, and you have a physical office here in the United States. So a beneficial owner is one. So who has to file this report? The beneficial owners. What are we looking at there? So a beneficial owner is one that has any sort of control in the entity. So generally, if an individual owns over 25% of the entity, it's considered to have it is considered to have substantial control. So if you're an owner of a business, now I have other businesses besides my accounting firm that I'm either fully own or partly own. So when I look at those other businesses that I'm a partial owner of, if I'm over 25%, I'm going to end up having to be on the report with the other owners as well. So an individual that owns over 25% of the entity or has substantial control inside the entity. So what does substantial control mean? So kind of in a nutshell, it has decision-making responsibilities. So we think of a corporate officer. So you may have a corporate officer that has less than 25% ownership. Think of in a C Corp environment. Where you have the corporate officers that are involved in the decision making. Their information is going to have to be disclosed. So corporate officer, someone who sits on the board of an entity or has certain types of financial arrangements with that entity that would result it has some sort of substantial control or material amount of control inside of that entity. Their information will need to be disclosed on this particular report, on this BOI report. So a trust is generally excluded, since trusts generally do not have to file with the Secretary of State's office. However, if a trust is an owner or has substantial control within that entity, that trustee is going to have to disclose his or her information on the BOI report. Okay, so essentially, if you own over 25%, or if you're in a corporate seat, in a board seat, or if you are involved in some sort of certain financial arrangements with the entity that would give you control, you're going to end up on this BOI report, or you're going to need to file the BOI report if you are the owner of that entity and include these individuals. So for entities that were created prior to 2024, the BOI reports must be filed by January 1st, 2025. So if you have an entity and it was opened prior to January 1st of this year, you have all of 2025 to get this report in. If you organize the entity, so incorporated, organized the entity in 2024, you have 90 days. Now, there's been some information out there. You have the full year, you have 90 days, you have 30 days, whatever the case may be. As of right now, according to the Department of Treasury's website, that is 90 days. So if you've established an entity in 2024, you have 90 days to file, 90 calendar days to file this report. Entities created after January 1st of next year have 30 days to file. Now, if you end up with a change, so you filed the BOI report and there's some sort of a change of ownership or change of beneficial, one of the BOI owners either changes, somebody drops off, somebody gets added on, whatever the case may be, you have 30 days to file an updated report. So once again, if you have an existing entity prior to January 1st, you have all of 2024 to file. If the entity was organized since January 1st of this year, then you have 90 days to file the BOI report. If you have any, so once you file the report, if there are any changes in the beneficial owners, you have 30 days to file an updated report. So what information has to be provided? So there are essentially 9 pieces of information that will need to be filed. So number 1, the full legal name of the entity. Number 2, any sort of trade names, DBAs that you have for the entity, the physical office address for the entity, the state of formation. So where your entity is actually organized or incorporated, the tax ID number or the EIN for the entity, the full legal name of the beneficial owners, social security numbers of the beneficial owners, dates of birth for the beneficial owners, their residential address, and then going to need a copy of your active driver's license or passport. So, and of course, I'm excluding the foreign piece of this. That's a whole separate conversation. But so any sort of your beneficial owners, you're going to need to collect this information. So you're going to need to, you should have all the information of your entity on file. But in regards to these owners, you may have owners that you're not going to have copies of driver's licenses, passports, things of this nature. So this information will need to be collected. So basically all the information of the entity, legal name, any sort of DBAs, where is the physical office located, the state that you're formed in, the tax ID number or EIN, once you get it to the individual level, all of their information. So their legal name, their residential address, social security number, date of birth, and then a copy of either their passport or their driver's license. Once this information is collected, then the report can be filed. And so by not doing this, the penalties can be severe, up to $500 a day to a maximum of $10,000 there. And then, and of course, they also put on here that, criminal penalties can also apply. So bottom line, this is something that's it's an annoyance more than anything, but just something that as owners now, business owners here in the U.S., just something we're going to need to be aware of, something we're just another compliance piece, just like our annual reports with the Secretary of State's office, tax returns, et cetera. Just something else that we're going to need to stay on top of. And so this may be something from a practical end that, when you kind of go through and you have meeting minutes, things of this nature, you end up doing any sort of a buy-sell arrangement, whatever the case may be initially, that should trigger either an email to your accountant or your attorney or a note internally if you're filing these things internally to make sure that these reports are filed. You set up a new entity, whatever the case may be, make sure that report gets filed within 90 days if you establish the entity. If you make any sort of changes and your report's already been filed, make sure that that updated report gets filed within 30 days. Hopefully this particular podcast was helpful. This is Josh Belk with the Belk on Business podcast. Hope you have a wonderful day.